Hello, I'm Russ Mould, AJ Bell's Investment Director, and welcome to the latest edition of Fundamentals, where I'll be looking at one of the most popular funds on the AJ Bell Youinvest platform over the last month, namely Jupiter India. This £575 million collective's mandate is to provide investors with long-term capital growth. It seeks to do so by primarily putting money to work in companies quoted on the Indian stock market, although it can also invest in companies based in Pakistan, Sri Lanka and Bangladesh, as well as those which generate a big percentage of their business in India. There is a yield, although it's only around 0.3%, and with this class of fund, dividends are reinvested. The annual ongoing charge figure is 1.1%, and for those who place weight on such things, Jupiter India gets a 3-star rating from Morningstar. Perhaps more importantly, it is ISA and SIP eligible. Fund manager Avinash Vazirani's portfolio has around 85 holdings, and the top 10 represent around a third of assets under management. Key shareholdings include Hindustan Petroleum, tobacco company Godfrey Phillips India, wonderful name, technology firm Infosys and vehicle manufacturer Force Motors. By sector, financial services, consumer cyclicals and energy are the biggest three areas in the fund, while telecoms, utilities and real estate, well, they barely figure, as we can see here. So those are the mechanics. The question is, why would your fellow investors be buying the Jupiter India Fund right now? And I think there are a number of possible reasons, 4 really. So first of all, any investors who think that the pound is going to fall further as a result of the Bank of England's 3-pronged monetary package from August will be looking to park money overseas, as foreign holdings will rise in value if once translated back into the pound, particularly if it keeps going down, and those holdings of course don't go down. The chart here shows how the rupee has gained on the pound over the last year. It's increased in value by about a fifth to just over 81 rupee to the pound from nearly 100 a year ago. Second, the new Reserve Bank of India Governor Urjit Patel cut interest rates at his first meeting in charge in early October by a quarter point to 6.25%. That's the 6th cut in 2 years, and this is helped by a good monsoon season that's yielding a strong harvest and lowering food inflation. Falling inflation and lower rates are both seen as capable of giving a boost to India's economy. Third, Prime Minister Narendra Modi remains committed to social and economic reforms designed to make India's economy more competitive. And finally, Modi's reforms, falling inflation and lower interest rates are all seen as capable of giving a boost to India's economy. The International Monetary Fund expects GDP growth of 7.6% in 2017, enough for India to potentially outpace China for the 3rd year in a row. That all in turn may explain why India's headline index, the Sensex, is trading just near all-time highs at a fraction under the 28,000 mark. Now, none of this equally is to say the Jupiter India Fund is suitable for everyone. India is an emerging market and therefore riskier than average. Modi's reforms could run into opposition. Tensions between India and Pakistan in Kashmir are escalating once more. The fund's yield is low, and the market, as already noted, has already done really well, so a lot of the good news could be in the price. You must therefore decide whether Jupiter India Fund, which ranks 3rd by performance out of a field of 13 on a 5-year view, fits your own personal investment goals, target returns, time horizon and appetite for risk before you consider buying it, so please do your own research. Thank you for watching, and I look forward to seeing you next time.